Hello everyone. Welcome to this training session on the term structure of interest rates. In this session, we'll try to cover some of the basic concepts involving the term structures, where the primary focus, right, some of the key areas which we would be dealing in this session would be in terms of understanding of the spot and the forward rates, and which will also help us in understanding what is meant by term structures, and further to that, and their interaction between the spot and the forwards and things like that, and also the various theories that are driving the term structure of interest rates. We'll talk about three different theories that will drive the term structures of the interest rates, so we'll be spending some time on that. And finally, and towards the end, we also will look at what we call as gross redemption yield when we talk about the interest rates and the bonds. How do we link the gross redemption yield with couple of other terms called NER par yield versus coupon bias? We'll talk about some of the key terms that will drive this space, and we'll also spend some times in terms of understanding the volatility of the present in the bonds, where the major focus will be towards the items like duration and convexity. We'll use different methods of durations, different ways in which we compute the duration, and finally we'll end up this session with the Reddington's conditions for immunization. If at all we have to say that our particular portfolio is immunized or not, our investments are immunized or not, what are the various tests we can do in that particular aspect? So these are the typical things which we would cover as a part of this session. So to start with, whenever we talk about the word called spot rate, right, in terms of bonds and the bond pricing, bond valuation, we use this word called spot rate a lot. Whenever we call something as a spot rate, it is nothing but the yield that is on a zero coupon bond. Let's say I have invested 100 today and the bond has given me 110 after 1 year. So this is a zero coupon bond because one, there are no intermediate payments between the initial date and the maturity date. So we call it as a zero coupon bond. And whatever the yield that this bond gives over the maturity period on an annual basis is what we call as a N-year spot rate. For example, we have an FD kind of stuff. Any FD, fixed deposit, can very well be looked at as a zero coupon bond because we are investing something now which will give whatever the value on maturity and nothing in the middle. Those are what we are calling as equivalent to zero coupon bond, right? The only difference being in a zero coupon bond, what is paid on maturity is known in advance, whereas the amount at which we would be depositing now is always based on the fixed amount that would be paid in future. Whereas in case of FD, probably we'll deposit a round figure today and we may get some kind of added interest in future at a later point in time. Let's assume for simplicity purpose, there is a fixed deposit which is going to pay us 1000 after 5 years, and we are asked to deposit 800 or 700 today. We are told that you deposit 700 today and that will give you 1000 after 5 years. in this case, this is one a zero coupon bond because it doesn't pay any kind of intermediate payments in the middle. So whatever is the annual rate of return on this zero coupon bond is what we call as a 5-year spot rate. Typically, the word spot rate is generally associated with any zero coupon bond. Even if it is a coupon bond, we may have to convert it into a zero coupon bond. There are various mechanisms to do that. So whatever is the interest rate that is available on this zero coupon bond of this kind of a risk is what we are calling as a N-year spot rate for this. So how do I find out the N-year spot rate using the compounding? This divided by this to the power 1 by 5. This is a compounding interest formula. So it is saying around 7.4% happens to be the 5-year spot rate. In this example, if I am taking this as the example, almost 7.39% happens to be the 5-year spot rate. So that's how we define N-year spot rate. Any kind of return that is obtainable on a N-year maturing zero coupon bond with a face value equal to 1. Because if the face value was equal to 1000, then we are talking about paying 700. But if the face value was equal to 1, we are talking about whatever is the rate that is associated. So around 7.39% is what is the amount that has to be paid on that zero coupon bond. And that is what we call as a discount factor. The discount factor is nothing but 1 by that particular amount to the power n. So because what is the discount factor in this case? The discount factor actually has come out to us as something as 1.42, right? Or probably 1 by 1.42, which will work out to, or the other way of writing the same, the discount factor is nothing but 700 by 1000, which works out to zero point 0.7. And the other way of determining that determines factor is, if at all we know the 5-year spot rate, what you can do is this to the power 5. If you are doing this, is anyhow coming out to 1 by 1.42. You do a 1 by of this, you will simply get the same zero point 0.7 itself. So that is where we are talking about this formula. If at all you know the N-year spot rate yn, if yn is equal to 5-year spot rate, or probably if someone says y5 equal to 7.4%, then it is nothing but a 5-year spot rate equal to 7.4%. Now that you know 5-year spot rate is 7.4%, you can find out the discount factor to each, so that you can discount that particular you can discount the cash flow of that particular period using this discounting factor. So the spot rate is a very important aspect in terms of valuing any kind of bond. We'll see at a later date. We'll take up one small numerical to see how this spot rate will help me in pricing a bond, how this spot rate will help me in calculating what should be the amount that should be paid to acquire a particular bond. So in short, two important things that we have to be comfortable with when we talk about the spot rate is, one, it is the interest rate that is associated with a zero coupon bond. And the second is, it is more associated, if at all you know the spot rate, you should be able to find out the discounting factor for each of the cash flows. On the same lines, we also bring in, so whenever we talk about the spot rate, the other way of talking about is, yeah, if I deposit my money for a 2-year period, what is the annual interest rate that I'm going to get? Deposit for 3 years, what is the annual interest rate? Deposit for 5 years, what is the annual interest rate? it may be different in all aspects. Probably when you go to the banks, you will see that for each of the years, the interest rates which they specify are different. So, as of today, if you are blocking your money for the entire 5 year or 3 year or 2 year period, what is the interest rate per year? This is not the excess. I mean, when someone says 2 year interest rate is 7% and 3 year interest rate is 7.5, it doesn't go as slab up to 2 year 7% and from 2 to 3 7.5. It does not go like that. For the entire 3 year period, it is given as 7.5% per annum. So that is what we are calling as a spot rate. Now, when we are talking about a spot rate, it is always right from the current period. From the current period to the next 5 years, what is going to be the interest rate? Because we are talking about an investment which is maturing after n years, and how much would be paid after n years. Everything is known in advance. So that is where we call, whenever we talk about an n year spot rate, right from now to the n years. So always the spot rate involves from now onwards, right? And let's say now we use a different term called forward rate. So whenever we use the word forward rate, it is the interest rate not from now. From now, if I am finding out a 3 year rate, we call it as the spot rate. But if I say after 1 year, I am finding out the 2 year interest rate, right? From now, a 3 year rate should be the same as, if at all I am talking about 1 year from now, whatever is the 2 years from that point, right? That is what we call them as forward rates. Not today, but whenever I am looking at the spot rate 2 years later or 1 year later, starting from some time in future, whatever is the interest rate that is not applicable from now but is applicable after some time in future, those are all called as forward rates. So whenever I say a forward 1 comma 2, it is nothing but that specific interest rate for 2 years, a 2 year interest rate after 1 year from now. So which means, okay, from now 1 year and the 2 year interest rate, which means overall from today, if I am looking at, it is about a maturity after 3 years. I'm talking about a bond which will mature in 2 years after 1 year. Probably look at it like this. The interest rate on a zero coupon bond which will mature in 2 years after 1 year, which means overall 3 years from today. So that is being denoted as the forward 1 2, because I don't know the interest rate after 1 year. See, if at all I'm going to take a bond after a 2 year bond, not today but after 1 year, I don't know what would be the prevailing interest rate at that point. So what we are trying to say is that particular interest rate is what we are calling as forward rate. Any interest rate which is not as of today but for some time in future, we are calling them as forward rates. Now, how do I link these two rates? The simple process that says is, okay, even if you deposit for a 3 year period, let's say if you are depositing for a 3 year period, how much money you are going to get? 1 plus, I mean, the multiplication factor for us is 1 plus yt to the power 3, compounding at the rate of yt every year for a 3 year period. What this says is this multiplication factor should always be equal to even these, which means first I deposit for 1 year, and whatever the money that I get, I deposit at the forward rate for 2 more years from then. Right? Forward rate for 2 more years from then. These two things should give me an equal value. That is what is the relationship between the forward rates and the spot rates. So from here I should be able to find out, because spot rates I know as of today, but forward rate is something about the interest rate in future. So how do I find out? I do it like this: 1 plus y3 whole cube by 1 plus y1. If I am doing, whatever I get is 1 plus f12 squared, and based on that, taking the square root, I will get f12, and from there I will get a 2 year forward rate 1 year from now. Simple example I'll take that would make things easier for you. Let's say a 1 year spot rate is given as 7%, and a 3 year spot rate is given as 8%. What does that mean in simple terms? If I have to understand this, if I deposit my money for 1 year, I'm going to get 7% return on it, whereas a 3 year deposit is going to give me an 8% deposit annually for a 3 year period. So from here, someone has asked me to find out what is F1 comma 2, which means what is the forward rate, what is the forward 2 year forward rate 1 year from now, 1 comma 2. 1 year from now, what would be the 2 year spot rate? Probably the easier way to understand is what would be the 2 year spot rate 1 year from now, not as of today, but after 1 year. So the simple way to find that out is nothing but, if at all I am depositing for 1 year, what would be the multiplication factor for me? If I deposit for 1 year, the multiplication is 1 plus this to the power 1. Okay, this is 1.07. If I deposit for 3 years, my multiplication is 1 plus this to the power 3. So this is it. Now 1 plus f12 whole squared is equal to the division by these two. So this is 1 plus f12 whole squared. So from here I can find out 1 plus f12, which is nothing but the square root of this, and from this I can find out f12, which is nothing but 1 minus of this, giving me that, okay, if at all I want the interest rate, 2 year interest rate after 1 year from now, it is going to be around 8.5%. This is the way we link the forward rates to spot rates. So today itself I will decide that a 2 year spot rate 1 year from now, which is same as a 2 year forward rate, 2 year forward rate right now is 8.5%, right? So the 2 year forward rate from time 1, which is 1 year from now, is equivalent to 8.5%. That is the typical way we calculate the link between the spot rates and the forward rates. So whenever we try to plot a graph of the various spot rates, okay, 1 year spot rate, 2 year spot rate, 3 year spot rate, different periods of spot rates with time on the x-axis and the spot rates on the y-axis. Whenever we are plotting a graph, the line or the curve that joins all those points is what we are calling as the term structure of the spot rate. That particular curve is what we call as the yield curve, and the changes that are coming out to the various rates are what are called as the term structures. The curve is called as the yield curve or the spot rate curve, because we are plotting the spot rates across the various time points, and because the interest rates are changing for different yields, we are calling that particular graph as a yield curve. Fine. Now, couple of interesting things in this context regarding why the interest rates for short term and long term keep changing. The interest rates for short term and the long term keep changing. The reason behind it is what is given by three major theories. Three major theories, and we call them as three theories regarding the term structure of the interest rates. So, one such theory is the pure expectations theory. What it says is everything demands the whatever is the interest rate, short term, long term, different people have different expectations about the short term and the long term interest rates depending on their historical movement, on their experience, on various conditions. Various market participants have expectations about the future interest rates. Let's say if the interest rates today are very high in the market, there may be a large section of people who keep expecting that the interest rates will go down in future. Similarly, if the interest rates are very low, you will find that there is a large section of people who keep believing that the interest rates will go up. It could be either based on experience, or based on understanding of the economics, or based on the historical movements in the interest rates. Whatever may be the mechanism that is being used, large number of people have different kinds of expectations about the future movement of the interest rates. Based on how they expect how the interest rates are going to move, the demand for either the long term investments or short term investments increases. If everyone keeps thinking that the interest rates are going to fall in the near term, so what would be the consequence? Everyone will stop investing for the short term because there is an expectation that the interest rates are going to fall in the near future. So there will not be much of a demand for short term investments, whereas there will be a large demand for the long term investments. So because of large demand for long term investments, the yields on the long term will keep going down. Large demand for long term investment, their yields or the interest rates for long term investments will go down, whereas the interest rates for short term investments will typically go up. Whereas if it is the vice versa, which means if the interest rates are expected to rise in the short term, simple expectation from the people is let's all invest for the short term period. So the moment you are investing for the short term, the demand for the short term will increase, and the higher the demand for the short term will result in lowering of the interest rates in the short term compared to the long term. So this is what a pure expectations theory saying. Whatever the demand for long term or short term interest, short term investments is heavily dependent on how people visualize how the interest rates in future are going to vary, and this visualization is heavily done based on the previous movements in the interest rates or the historical experience or various other criteria used by the economists. Then the next thing we are going to look at is the next theory, which is the liquidity preference theory. As the word itself is saying, you give some kind of a preference to the liquidity. Why is liquidity coming into picture here? We are talking about a short term investment versus a long term investment. In general, if I am investing something for a longer term, I'm actually blocking my money for a longer period, right? I'm locking my money, blocking my money for a longer period, which means I'm taking more risk, and the interest rates can fluctuate slightly more on a longer term compared to on a shorter term. Let's say if something is getting matured tomorrow versus after 1 year. For tomorrow itself, the chances of fluctuation in the interest rates from today, major fluctuation from today, the chance is much, much lesser. Whereas if I'm looking at after 1 year, the chance of a major fluctuation is very much possible. So because of that, what we are saying is whenever someone is locking or blocking their money for a longer period, they are taking a little bit of extra risk compared to someone who is investing for a shorter period. And as per the risk aversion principle, anyone who is taking a higher risk, he will take that risk only when he is compensated for that higher risk in terms of higher return. So obviously, this mechanism, this theory, which is a liquidity preference theory, is saying that the demand, it's just not the demand for short-term investments based on the future expectations, but definitely the longer-term ones will have slightly more returns compared to the shorter-term ones because of the liquidity preference that has to be given. So that's the second theory coming up, not just the expectations. Probably whatever are the expectations, the actual return should be slightly more than the expectations because of the risk that is associated with high risk that is associated with locking and blocking the money for a longer period. Then we are talking about the third major theory governing this, which is the market segmentation theory. As per this theory, what we are saying is the different investors choose different investments in the bonds based on their liabilities. For example, a pension fund company, they typically invest in long term investments because most of the times the liabilities from their side are also long term in nature. So for the various uh, investors, their investment needs are completely different. So if I'm talking about a bank, probably they prefer more of short term investment because their liabilities for a bank are nothing but the deposits which they are collecting from the depositors. So they may withdraw at any point, which means the liabilities for the bank are very short term in nature, whereas for a pension fund company, they are more long term in nature. And what this term structures is explaining is because different parties have different kinds of requirements. So the demand for the long term and short term investments differ completely based on how the requirements of different investors are changing over time. Because at some point there may be a lot of trust for pension funds for pension funds to invest, whereas at some point in time there is a lot of investment done by the banks. So depending on who are the major participants in the investment market, there will be a difference associated with the long term versus the short term kind of investments. So that is where what we are saying is the borrower's requirement, the lenders or the investors' requirements keep changing with time. This year I might have invested more, but next year my investments are much much lesser, or vice versa. Similarly, if you look at the other side, the borrowers, whether it is corporations or government or various other entities who are getting into the borrowing process through these fixed income securities, even their requirement changes. Last year, most of them might have borrowed, but this year the number of short-term borrowings are much much lesser. So because of that, even the supply also differs. So depending on how the demand and supply are varying for short term versus the long term investment, this theory says that the interest rates for short term versus long term also differ. If more demand for short term exists whereas less supply is there, obviously the interest rates will come down. Less number of borrowers but more number of lenders in place, the interest rates will obviously come down. Or on the other side, if there are more number of borrowers but less number of lenders, there is a very high chance of the interest rates going up. So what we are simply saying is the interest rates for short term or a long term will depend primarily on the demand and supply associated with the investors and the borrowers. So depending on the major investors being let's say pension fund companies or banks or insurance companies or various entities like this, whereas on the other side the borrowers could majorly be corporations or government or any such kind of entities which require capital for running their businesses. So these are the three different types of term structures which are governing the movements of spot and forward rates in the future. Okay, moving on to the next. The next important aspect which we'll try to cover in this session is, okay, now that I know the various spot rates, how do I compute what is called as a gross redemption yield, which is nothing but the annualized yield on that particular bond, annualized return on that particular bond, which is also equal to the internal rate of return on the bond. The simple logic, let me take, probably will take an example like this. A 1 year spot rate is 6%, 2 year spot rate is 6.5, 3 year spot rate is 7. Okay, let me take this example. This will solve a lot of aspects for us. A 1 year spot rate, I'm saying it is 6%. A 2 year spot rate is 6.5%, and a 3 year spot rate is 7%. All right. Now, what we are saying is, we'll talk about a bond which is paying 8% annual coupon. What do we mean by 8% annual coupon? Every year it will be paying 8% of the face value on an annual basis, and also it also because we have said it is redeemable at par, the principal refunding which it does after 3 years is the par value itself, which is 100. So the typical cash flows associated with this bond after 1 year, if I pay something today, after 1 year I will be receiving 8 on each bond because the face value of the bond is 100. After 2 years also I'll receive an 8, and after 3 years I'll receive 108 because 8 is what I will receive as the coupon and 100 is what I'll receive as the principal repayment, because one, it is redeemed at par, and two, the maturity date is a 3 year maturity kind of a bond. So in the maturity year I will be receiving even the premium also back, I mean the principal also back. Now what is that we are saying? If at all I have to find out, the first thing, my intention is to find out the gross redemption yield. Sometimes people also call it as the IRR of the bond. So what we do in this calculation is, first we will find out the price of the bond. To find out the gross redemption yield, we should also find out the price of the bond using the spot rates. So how do I find out the price of the bond? For that, because the spot rates are given, you find out the discounting factors from the spot rates. Okay, we have talked about the discounting factors from the spot rates, which is nothing but 1 by 1 plus that particular period spot rate to the power those many years. So I'll take it as 1 by 1 plus this particular spot rate to the power 1. This is the discount factor. 1 by 1 plus this particular spot rate to the power 2. 1 by 1 plus this particular spot rate to the power 3. These are the discount factors associated with each of the 3 periods based on the spot rates. Now what we are saying, multiply each of the cash flows with the corresponding discounting factors. So that is what is giving me these numbers. Add up all of them, which will give you the price. The price of the bond, which is also called as a no arbitrage price. The price of the bond is equivalent to the summation of all these 3. If at all I have to find out the no arbitrage price for this, it is around minus 1, it is around 102.76, because it's as good as saying if I pay 102.76 today and the bond gives me 8 after 1 year, 8 after 2 years and 108 after 3 years, it is in line with the 3 years spot rates, 1 year, 2 year as well as the 3 year spot rate. So the first thing always, okay, whenever we talk about the price of the bond, will not have this negative sign, because when we talk about it as a cash outflow, we'll put it as a negative sign, whereas the price of this kind of a bond, which is going to pay you 8 after 1 year, 8 after 2 years and 108 after 3 years, going with 6, 6.5 and 7 as the spot rates for 1 year, 2 years and 3 years respectively, the price of the bond is 102.761. And how do I use this price information to arrive at the gross redemption yield? I'll find out what is that specific annual rate of return. Right? You can find out what specific annual rate of return. Let's say you are taking 6%, 7%. What specific annual rate of return you have to take if at all this minus 102 should come out. You are depositing minus 1, you are investing 102 today and you have to get these kind of cash flows. Instead of having 3 different interest rates for 3 different years, what should be that one single interest rate which for the entire 3-year period? That is what we are calling as the gross redemption yield, which also will work out as the IRR of these kind of cash flows, which is working out to around, if I do a little bit of more manipulation on it, it is coming out to around 6.95%. What does this mean to us? If at all, instead of taking 6, 6.5 and 7 for 3 years, if I take the discount factors based on 6.95 for each of the years, all the years the same 6.95%. This is the discount factor based on 6.95 for 1 year. This is the discount factor based on 6.95 for 2 years. And this is the discount factor based on 6.95 for 3 years. Now if I try multiplying the cash flows with the discount factor, the price should be the same. Even if I am doing this kind of a work, the price should be the same. That particular interest rate, you see, both are same. That particular interest rate which will give me the discount factors in such a way that if I do the price of the bond using the spot rate approach or using that one single interest rate for the entire maturity period, both of them should result in the same price. That is what we are calling as a gross redemption yield or sometimes people also call it as IRR, and sometimes people also call it as yield to maturity of the bond. These are the various terms associated with it. So for every bond, to find out the gross redemption yield, couple of things that are required are, you should be able to find out the price of the bond, and assuming that you are purchasing the bond at that price, what is the annual yield that you are going to get on that particular bond. That is what we are calling as the gross redemption yield of the bond, or the YTM, yield to maturity of that particular bond. Then, so that is the numerical here. Then on the same lines, we also talk about what is called as an N year par yield for the bond. In the same example, if at all I have to talk about N year par yield, what does that mean? Here I will not change. Here I will set this to 100 only. This will not become 102.76. This will be 100 only. So if at all I am purchasing this at 100, and I will alter this amount now. What should be the coupon every year? If at all the purchase price is also 100, as well as the maturity price is also 100. So which means, what are the typical cash flows? Today if I spend 100 on it, it should give me some C after 1 year, some C after 2 years, and some 100 plus C after 3 years. This C is what I have to typically find out based on the discount factors itself. Now, if I assume that these are the interest rates for the next 3 years, right? If I assume the same spot rates for the next 3 years are these, which means the discount rates are these. Now, what we are saying is, I'll not take these as 88 and 108. Probably this will become C. I'll take it separately. So this will become C, this will become C, and this will become 100 plus C. So in a way, and I have to purchase the bond at 100 itself. So what is that we are saying now? The 100, which is the purchase price, should be equal to C times the first discount factor, which is 0.943396, plus C times 0.881659, plus 100 plus C times 0.816298. This is what we are saying as determine the C in this aspect, which will actually give us what should be the price, what should be the annual coupon, if at all the redemption value as well as the purchase price, both of them should be the same, given different spot rates for different periods. This is what we are calling as the N year par yield. So even from this arithmetic, it is coming out that if at all I have to find out the C, I will simply do it as 100 minus 100 times whatever is the final discount factor. So this, just a simple arithmetic on that, divided by the 3 years discounting factors. The 3 discounting factors sum is what is coming out, which will work out to 6.95. So instead of 8%, if I define 6.95% coupon rate, what we are saying is, it will be, if you can purchase this at 100, and it will pay you 6.95 every period, and 100 on maturity. So this particular 6.95 9548% is what we are calling as 6.9548% is what we are calling as the N-year par yield. That particular coupon payment that has to be done every year, so that the bond can be purchased at par itself, given the various spot rates for different periods. And what you are observing as a very simplified scenario is it is online with your gross redemption yield itself. And finally, we also get exposed to what we call as coupon bias, which is nothing but for each of the years we'll decide the coupon bias as the difference between the N-year par yield and the N-year spot rate. So for a 1 year period, the N-year par yield minus N-year spot rate is going to be 0.95%. N-year par yield minus N-year spot rate is going to be 0.45%, whereas it is going to be negative in case of the 3-year scenario. So this is what we call as the coupon bias. So we have to be slightly comfortable with these kind of calculations associated with the N-year spot rates and the gross redemption yield, N-year par yield, and finally even computing the coupon bias also, right? Then, so even if forward rates are given here, the question is where the forward rates are given. So probably you can convert the forward rates into spot rates. How do I convert if I'm given F12 is equal to 7%, F01 is 6%. F01 is nothing but 1 year spot rate. Just understand this. 1 year spot rate 0 years from now, which is 1 year spot rate itself. So 1 year spot rate is given as 6%. 2 year 2 year rate 1 year from now, which is 1 year forward for a 2 year bond, is what is given as 7%. So if I combine these two, actually I'll get a 3 year spot rate. Because how do I arrive at 3 year spot rate here? 1 year spot rate, which is 1.06 into 1 year forward, 2 year forward rate 1 year from, or 1 year forward rate for a 2 year period, which is coming out to 1.07 whole squared. If I take the cube root to the power 1 by 3 for this, whatever the rate that I'm going to get is actually a 3 year spot rate, which is F0, 3. So we already have F0, 2, F0, 1, and now we are deriving F0, 3. You can make the computations exactly on the same lines as we have done right now itself. So there should be some level of comfort in terms of computing the gross redemption yield and N-year par yield, and finally finding out the coupon bias for each of the years. All right. Now we'll move into the next important aspect of our session, finding out the volatility associated with the cash flows. Right, the earlier things whatever we have done are finding out the present value of the cash flows. Now we will spend some time in terms of understanding the volatility associated with the cash flows. What are the various mechanisms we can use to actually find out the volatility associated with the cash flows, and define some of those kind of definitions for us. This volatility is primarily arising because of changes in the interest rate. If the interest rate changes, by what extent? Probably if the interest rate changes by 1%, by what extent is the price going to change? Right, today the price, which is the present value of the future cash flows, we have computed based on the current interest rate assumption. But if the interest rates go up or go down in the future, what could be the change in the value of the bond, or what could be the change in the present values? And that is what we are calling as the volatility. What is the change in the present? That is where we called it as a differentiation. Differentiation is nothing but change in value. So what is the change in the present value in the of the I of the based on the interest rate? If the interest rate changes by some delta, what would be the change? What would be the percentage change or proportionate change that could come up in the present value as a proportion of the original value itself? That's what we are calling as the volatility. And the prime name associated with the volatility is the duration, or the which in a better way we even call it as the effective duration, right? So we can do it for a numerical, or probably we can even do it for the same example. We can actually continue for this same example also, because this is more simpler and more easier for us to understand. So we are talking about, let's say this is the same coupon bond, and these are the interest rates: 1 year spot rate, 2 year spot rate, and 3 year spot rate. And what we are saying is, if at all, if at all the interest rates are going to change by a little extent, see, either I can use the gross redemption yield, which is the same rate for the entire period, or I can use the spot rate. For simplicity purpose, we can very well use the gross redemption yield. Typically, if we look at what is the formula which we are going with, finding out the price. If I'm talking about a price for that example, we have done is probably C by 1 plus R, which is the coupon, C by 1 plus R squared plus 100 plus C, or probably P plus C by 1 plus R cube, or probably 100 plus C itself, because which is the principal, whatever is the face value, 100 plus C by 1 plus R cube. Now what we are saying is, because this here, please take the R as the gross redemption yield. Even if it is given in case of spot rate, for simplicity purpose, if I am taking it as the gross redemption yield, what we are saying is, now take the derivative of this price. This is what is PV dash. Take the derivative of this C with respect to R, or with respect to the interest rates. So what will happen, just assuming that your concepts of derivatives are fine, we are taking it as minus C by 1 plus R squared minus C into 2 by 1 plus R cube minus whatever 100 plus C into 3 by into 3 by 1 plus R to the power 4, right? Because 1 by R, the derivative is nothing but minus 1 into R to the power of minus 2, which is nothing but minus 1 by R squared. This is what I am using, minus 1 by R squared derivative. If I want, it can be written as R to the power of minus 2, and the derivative of this will become minus 2 into R to the power of minus 3, or minus 2 by R cube. So that is what is the logic we are using. So basically it is going like, it can very well be taken as whatever is the earlier scenario, C, it is going as minus of, if I take the minus out, C by 1 plus R whole squared plus 2C by 1 plus R whole cube plus 3 into 100 plus C by 1 plus R to the power 4. It is actually going ahead like this, right? So if I am doing this logic, actually if we see the same logic is going in the scenario of an increasing annuity, where the annuity is actually increasing at the rate of C. But for simple kind of solutions, we can even look at a simplification like this, where we are talking about minus of C and 1 plus R whole squared, whole cube and whole power 4. If I am taking those kind of things, so if, because I'm going with the gross redemption yield, what I can very well do is the discounting factors, I'll take it as 1 by 1 plus R whole squared to start with, then 1 by 1 plus R whole cube, then 1 by 1 plus R to the power 4. These are the revised discounting yields, and C, 2C and 3 times the third one. 1 time the first one. So I will do this as 1 times the first cash flow into the first discounting factor. Then 2 times the first cash flow, the second cash flow into the second discounting factor. Then we are talking about 3 times the third cash flow into the third discounting factor. So the change whatever we are talking about is something like this. The PV dash is actually working out to this layer, which is coming out to the summation of all these things. The PV dash is coming out to 267, and what we are saying is the change wise, if I want, we are talking of minus PV dash by PV. So the duration or the effective duration in this case, what we are saying is the effective duration, what we are saying is nothing but minus of 267.72 divided by the original price, which happened to be 102. So this is coming out to minus 2.6. So how do I interpret this minus 2.6? Probably for every 1% change in the interest rate, there is a 2.6% change in the price of the bond. A 1% increase in the interest rate is resulting in a 2.6% drop in the price of the bond. So the price of the bond is changing by 2.6% per every change in the interest rate. That is the way we will use the method of duration. So probably if at all I am predicting that the interest rates are going to increase by 1% in the next 6 months, probably I can think that this kind of a bond, the price of the bond will actually fall by around 2.6%. So the other way of saying is, if the interest rates go by 1% up, all we are saying is the price of this bond will drop by 2.6%, which means it can go to 100.08. If the interest rates increase by 1%, the value of this bond will come down to 100.08, resulting in that much of a loss. The loss that can come out on the value of the bond is something equivalent to that. That is how the effective duration is a measure of volatility, which means the higher is the duration, it's also telling me that the higher is the percentage change in the price of the bond for a 1% change in the interest rates, which means the higher the duration, higher the volatility associated with that particular bond. So that is one way of calculating the volatility. Whereas there is another method which is also called as the discounted mean term mechanism, or also called as Macaulay duration. So while the earlier one was called as the overall effective duration, we are also calling something as a Macaulay duration, which is nothing but the weighted average of the time with the discounting factor. The weighted average of the time with the discounting factor. So discounting factors are these are the discounting factors assuming the gross redemption yield. So the weighted average of them, which is the weighted average of the not the discounting factors, were weighted average on the present values of the cash flows. So these are the weightages. Based on these weightages, we will find out, we will multiply this by 1, this by 2, this by 3, and divide by the sum of these three. That is what we are calling as the Macaulay duration, which is nothing but, okay, this number, which is the cash flows, is multiplied by 1. This, the second cash flow, is because we are getting the second, this is the present value of the second cash flow, which is going to be received after 2 years. So this is equivalent to this value. And because we are going to receive this after 3 years, we are multiplying this by 3. So these are the total present values. And what we are saying is, you sum up all these things, right? You are summing up all these, which is ending up with 286. And what you do is this, you divide by the summation of all these three present values, which is nothing but the price. So what we are saying is the Macaulay duration in this case. The Macaulay duration in this case is nothing but 2.7863. How do I link these two things? The effective duration is 2.6, whereas the Macaulay duration is 2.78. What this says is, for a particular bond, right, for a particular bond which is going to if at all these are the characteristics of the bond, what this is saying is, if I have to take an equivalent zero coupon bond, or probably the average maturity duration for this kind of a bond is 2.78. So the higher the maturity duration associated with it, the higher is the riskiness associated, because this duration measures the average amount of time that it takes for the entire bond to mature. Because some cash flow comes after 1 year, some comes after 2, some comes after 3. So what we are saying is different amounts come at different periods of time. So because of that, I'm trying to find out on an average what is the maturity period. And we also understand on the other side, the longer the maturity period is, the higher is the risk associated with the bond with respect to the fluctuating interest rates. So that's how the higher is the Macaulay duration also, the higher it would be, the higher kind of an impact it will have in terms of the value of in terms of the maturity associated with the bond. All right. And the simple way to link these two things is, you multiply the effective duration with 1 plus I, you will get the Macaulay duration. So let's try out effective duration you multiply it by 1 plus I, or the gross redemption yield. This should be equivalent to the Macaulay duration itself. So that is what is the relationship we are defining between the effective duration and the Macaulay duration. So even if effective duration is given and I have to find out the Macaulay duration, all I should be able to find out is the effective duration multiplied by 1 plus I, where I is the effective rate for that particular period. Then the next aspect which we are focusing on is the convexity. We have already seen, just to explain the relationship, the price to yield relationship. We have seen that it is a curve. As the interest rates increase, the price of the bond actually falls, and vice versa. And when we have taken the duration, it is nothing but kind of the first derivative, because we said PV dash with respect to I divided by PV, which is nothing but, if I'm looking at for a curve, it is nothing but the tangent to the curve. Duration is nothing but the tangent to the curve. Now, when I'm using the duration to estimate the percentage change in price, the actually in this area of the interest rates, there is not much of a problem. The line and the curve more or less are overlapping. Whereas if I'm talking about at a very high or very low kind of interest rates, what we are seeing is the duration is predicting only this much, whereas the actual price is here. Or at this layer, the duration is predicting only this much, whereas the actual price is here. So there is a gap between what the duration is predicting and what the actual price is. So to minimize that gap, we are introducing the next derivative called as the convexity, which is a measure of the curvature, right? So same logic again, if I'm going with C by 1 plus R plus C by 1 plus R squared plus C by 1 plus R cube, what is the duration? We have taken out minus out, and we have said C by 1 plus R squared plus 2C by 1 plus R cube plus 3C by 1 plus R to the power 4 is what is the duration. Now the same logic, they differentiate it once more, which again minus will go off. Now C into 2 by 1 plus R cube plus 2C into 3 by 1 plus R to the power 4 plus 3C into 4 by 1 plus R to the power 5. This is what is the PV double dash, present value for the double differentiation of the price. So probably if I do the same logic, I have to find out 1 plus R cube and to the power 4 and to the power 5 as the 3-year discounting factors. Alright, let me do that. 1 plus R cube, 1 by 1 plus R cube. So here I am doing 1 by 1 plus R to the power 4. These are the discounting factors now. 1 by 1 plus R to the power 5. If I am doing these are the discounting factors. And now what I'll take, 2 into, okay, here it would be C plus 100 because even the principal will come out. So we are talking of 2 into the first coupon plus 6 into second coupon plus 12 into third coupon and something like that. So I'll take this as 2 into the first coupon into the discounting factor, and here also 6 into the second coupon into the discounting factor, And similarly 12, 3 into 4, 12 into the third payment into the third discounting factor. So the summing of all these things is what is PV double dash of I. So this is the value of PV double dash of I, and from here I can find out the convexity factor, which is nothing but PV double dash of I divided by PV of I. PV of I is nothing but sum of the present values or the price associated with it, which is nothing but 9.49. So in this case, the convexity is 9.49. The higher the convexity is, what it means is the interest rates will change very drastically. The spread is going to be much higher, whereas the lesser convexity indicates that the spread is much lesser. So that is how in this context we are computing the convexity. We can also use the scenarios of the increasing annuities. When I discuss the numericals, I'll use the examples of increasing annuities and the actuarial tables associated with the increasing annuities also to compute the convexity. But on a conceptual part, the the duration is nothing but the first derivative of the price, whereas when we are talking about the convexity, our focus is on the second derivative with respect to the price. All right, then one major aspect, why are we computing all these durations and convexities and all these kind of things on the data? What we are simply saying is we will do a similar exercise with our assets as well as with our liabilities. The first thing, we'll do this exercise with our assets as well as liabilities. And for any portfolio manager, uh, at a very one individual portfolio layer, or even at a fund manager layer, or even at a bank layer, which is handling multiples of portfolios, for any kind of an organization or a portfolio, what we are saying is, I want to check out whether that portfolio is immunized or not. What do I mean by immunization? If at all there is a small change in the interest rate, am I still protected? Even if there is an adverse change in the interest rate, am I still protected? Or is there a chance of gaining some kind of profit if the interest rate change slightly? Right, if the interest rate changes slightly, there are two things. One, I should not be heading into a loss. Two, if possible, I should be able to make, there is scope for making some profit. That is where we are talking about our portfolio being immunized. And in those kind of cases, how do I really check out whether my portfolio is immunized or not? For that reason, we'll find out all these three aspects. One, the present value. Two, the effective duration, or probably the duration mean time or Macaulay duration. Any one of them. We'll find out the duration. We'll also find out the convexity. And this are done for both assets as well as liabilities. And what it says is, what this Reddington's condition for immunization say is, the present value, if the present values of both the assets as well as liabilities, both of them are equal, that is one condition for immunization. Then the next derivative layer, the durations of both assets as well as liabilities should be equal. Then you will not have any kind of risk associated. If the duration of the assets is matching with the duration of the liabilities, Then also a change in an interest rate will not have major impact on the portfolio. And three, the convexity of the assets, if they are greater than the convexity of the liabilities, what we are saying is the scope for making a profit is slightly more. The convexity of the assets is greater than the convexity of the liabilities, there is a chance of making slightly more profit. And at the same time, our portfolio is immunized, which means by taking a slightly lesser amount of the similar amount of risk, we are able to increase our profits in this scenario. So, on any kind of securities or portfolios or funds, we will be computing all these three aspects: the present value in terms of price, to the if both of them are equal both for assets as well as liabilities. We also will check out for the volatility more in the form of duration or Macaulay duration. And three, in terms of convexity, which will talk about the second derivative of change with respect to price. So if these three conditions are met, we can very comfortably say that our portfolio is comfortably immunized. We'll look at one or two numericals regarding this aspect also, right? But at least getting a conceptual aspects and the basic calculation aspects relating to all these important terms and features like spot rates, forward rates, relationships, then the theories of term structures in terms of expectations theory or liquidity preference theory or even the market segmentation kind of a theory. Finally, computing the gross redemption yield and the NER par yield, getting into the computations of the volatility as well as the Macaulay duration, which is the discounted mean term for the bond, computing the convexity, the need for computing convexity, and finally the Reddington's conditions for immunization of the bond. I hope all these concepts are quite comfortable for you. If you have any further queries regarding these kind of stuff, these kind of concepts, you can very well get in touch with me on the number that I have provided below, or you can even send in an email to the address which I have specified there. Thanks a lot for listening to this session. Thank you very much.
Now let's look at how do we compute the spot rates and the forward rates, interest rates, given the different kinds of bonds and their various maturity periods. So here in this case, if we see, we are talking about three types of bonds. One is a 1 year maturity bond, a 2 year maturity bond, and a 3 year maturity bond. And each bond is having some coupons, and all of them are giving 12% as the coupon. All right, and their effective gross redemption yield, or sometimes we call it as yield to maturity, their yield to maturity or gross redemption yield for this bond, it is around 8.5%, 7.4%, and 10.2%. Now, when I talk about the spot rate for each of the periods, for the first period, we know that the YTM itself is same as the spot rate. So for the first year, we know that the spot rate could be 8.5% itself. But from the second year onwards, if I want to find out the spot rate, I really need to get into the process of finding out the price of each of the bond, right? The price of at least these two bonds need to be found out using the YTM or using the gross redemption yield approach. Based on that, find out the price of this 2-year bond and again take it as the coupons discounting to each of the periods separately to find out the spot rate associated. So it's a step-by-step process. We can put the same into a spreadsheet to start with, right? So we have the scenario of a 1-year bond, a 2-year bond, and a 3-year bond. All right. So the maturity periods obviously are, this is 1-year maturity, this is 2 years maturity, and this is 3, right? And we can also talk about the coupon, assuming that the face value is 100. We can talk about the coupon in all the cases being 12% itself, but the gross redemption yield is differing in each one. 8.5% for the first one, 7.4% for the second, and 10.2% for the third. Okay, 10.2% for the third. Now, so the 1 year, look at the 1-year bond first of all. If I look at the 1-year bond, what are the cash flows that are associated with 1-year bond? Because the coupon is 12, the 12 is going to come after 1 year, the coupon, and the maturity amount, which is the face value, because we are talking about redeemed at par. For that 1-year bond, the face value is going to be 100. So at the end of 1 year, 112 is going to be the cash flow. So I discounted by 8.5% the gross redemption yield to get the current price of this 1-year bond. So the price of this 1-year bond, the price of this 1-year bond is nothing but 112 divided by 1 plus 8.5%. So the price of this is 103.22, and because there are not multiple payments, the spot rate also, when there is only one single cash flow, one single cash flow happening at only one point in time, the spot rate as well as the gross redemption yield will be the same. That is one thing we have to remember. If in case there is only one cash flow altogether, especially for that 1-year bond, there is only one cash flow. All the 12 coupon plus 100 face value, they are all paid at one point end of 1 year. So there is no second cash flow. So in case where there is only one cash flow, what we see is the spot rate will be equal to the gross redemption yield. That is what we are seeing in this case, right? Whereas when it comes to the 2-year ones, that is where the difference comes. Okay, in the 2-year ones, the 12 is the coupon that is coming at the end of 1 year. 12 is the coupon that is coming at the end of 2 years, and at the same time maturity, the redemption value of 100 is being paid. So overall the cash flows are 12 at the end of 1 year, 112 at the end of 2 years. So if I am discounting both of them with the gross redemption yield, I am discounting this by 1.074, and this I should discount by 1.074 squared. And this is what will give me the price of this bond at the end of the price of this 2-year coupon bond. right? Then after that, I'll use this price and then discount each of the years, each of the cash flows with their corresponding spot rates. Now that so first I should find out the price of this bond, going with 12 by 1.074. So 12 divided by 1 plus 7.4% plus 112 divided by 1 plus 7.4% square. So the price of this bond is going to be 108.271. Now how do I use this information for computing the 2-year spot price? I'll say 108.271 is equal to 12 divided by, I use 1-year spot rate which we have already found, 1.085, but the 2-year spot rate we don't know, so probably you call it as 1 plus I2 whole square. So from here you can simplify and find out I2, which is the 2-year spot rate. So in this case I can say 108.27, and as a basic calculation I can say 112 divided by 1 plus I2 squared is equal to this minus this. So 108.27 minus a bit of calculation here, 108.27 minus 12 divided by 1.085. 12 divided by 1.085 is giving me 97.21. So 112.1 plus I2 squared is 97.21. So a bit of mathematics and rearrangement. 1 plus I2 squared is 112 divided by 97.21. So that is going to give me 112 divided by 97.21. This is what is 1 plus I2 squared. Taking the square root of that will give me 1 plus I2, and subtracting 1 from it will give me I2. So the I2 in this case is 7.34%. So 7.34% is the spot rate corresponding to the 2 years. The 2-year spot rate from this numerical is working out to 7.34. The same logic we should do for a 3-year so that we get a comfort level in terms of practice. Yes, 12. The cash flows for a 3-year bond are 12, 12 and 112. All these 3 years I will discount by 1.102, which is the gross redemption yield for all these periods, to determine the price. So the price of this can come out as 12 divided by 1 plus this plus 12 divided by 1 plus this squared plus 112 divided by 1 plus this cube. This is what is giving me the price of the 3-year bond. So using the same number 104.46 is equal to the first 12 I will divide by the 1-year spot rate 1.085. The next 12 I will divide by the 2-year spot rate 1.0734 squared, and the next 112 I'll divide it by 1 plus I3 cube. So the same thing now, 112 divided by 1 plus I3 cube will be given by subtracting these two numbers. So what I should do here is 104.46, okay, minus 12 divided by 1.085, 1.085, which is the spot rate, minus 12 divided by 1.0734 squared. So this is what is 112 by 1 plus I3 cube is 82.99. So from here I can get 1 plus I3 cube is 112 divided by 82.99. This is 1 plus I3 cube. The cube root of it will give me 1 plus I3. This is 1 plus I3. So from here I subtract 1 to get I3. So the I3, which is the 3-year spot rate, is somewhere around 10.51%. So these are the three spot rates: 1-year spot rate, 2-year spot rate, and 3-year spot rate that I can derive from the corresponding bond prices. Now, then working out, once I know the spot rates of each of the periods, I can even get into the computation of the forward rate. So the computation of a forward rate in this case, at least in the first case, okay, so for the between 1 and 2, between 1 and 2 years, the forward rate is given by 1 plus I2 squared should be equal to 1 plus I1 into 1 plus forward from 1 to 2 years. So based on that you can find out 1.0734 squared is equal to 1.085 times 1 plus the forward rate. So the other way I can get 1 plus the forward rate is equal to 1.0734 squared divided by 1.085. So here if I want the forward, I can take it as 1.07 squared divided by 1.085. This is 1 plus F1. I subtract 1 from it. This gives me the forward rate. So the forward rate between 1 to 2 years is going to be 6.19%. The same logic I can use between 2 and 3. 1 plus I2 squared into 1 plus forward between 2 and 3 years is equal to 1 plus I3 squared cube. So from here it comes 1 plus the forward between the 2 and 3 years is nothing but 1 plus I3 cube divided by 1 plus I2 squared. The same logic if I am applying here, 1 plus I3 cube divided by 1 plus I2 squared minus 1 gives me the forward rate between the second and the third year. So in this case it is working out to the 17.14. The same way I can look at a 2-year forward rate if required from the first year onwards. So between 1 and 3, if I want to know the forward rate, it is nothing again but 1 plus I3 cube is equal to 1 plus I1 into 1 plus F from the first year for a period of 2 years squared. So from here again 1 plus F12 squared from the first year for 2 years, means from between 1 to 3 years. This is equal to 1 plus I3 cube divided by 1 plus I1, and I take the square root of that to give me a 2-year forward rate starting from the first year. So this comes out to 1 plus I3 cube divided by 1 plus I1. This will give me 1 plus F2 squared. So I take the square root of this same to get 1 plus F2. This will give me 1 plus F2 and a subtraction of 1 gives me F12. So the forward rate, 2-year forward rate 1 year from now means the forward rate between 1 and 3 years is going to be 11.53%. So you can use any combination. Once you have the bonds of different maturities, you can very well get into the computations of the spot rates and the forward rates associated with the different maturities. Alright. This is another interesting numerical from spot and forward rates, right? Where again, given some spot rates, some forward rates, we are trying to find out the value of some investment. So we are given the 1 year spot rate 8.8%. Then I have the 2-year spot rate, 3-year spot rate. Along with that, I have the forward 2-year forward rate from time 3, means between 3 and 5. The forward rate is being taken as 14.6%, and 1-year forward rate from time 4 means F4, 1 or 4, 5, somewhere between 4 and 5 years, it is expected that the interest rate is 12%. So we are asked to find out the forward rate value from time 1 for a 3 years. So which means between 1 and 4 is what we are supposed to find out. Now, if I know the spot rates for 4 years and 5 years, remaining all calculations can very easily be addressed. So what we can typically think of doing is, using this information, I can try finding out first of all a 5-year spot rate. How do I get 5-year spot rate? So 1 plus R5 to the power 5, whatever is the 5-year spot rate. I'll take the 3-year spot rate 1.11 cube, and between 3 to 5 for 2 years I have 14.6%. So this will give me the 5-year spot rate. The spot rate for 3 years, and between 3 and 5 years per year there is a 14.6%, which is the forward rate. So this will help me in terms of arriving at R5. Okay. So how do I get my R5 here? First 1 plus R5 to the power 5 is what I will try to find out. So which will help me to find out 1.1 cube 1.146 squared. Then I am doing the multiplication of these two, 1.74. This has to be raised to the power of 1 by 5. Okay, raised to the power 1 by 5. That is 1 plus R5. I subtract 1 from it. This gives me the 5-year spot rate, which is R5. The 5-year spot rate in this case comes out to 11.82%. Fair enough. The 5-year spot rate is 11.82%. Now the same logic I will use to find out the 4-year spot rate. Now that I know whatever 5-year spot rate is this much, 1.1182 to the power 5 is whatever the 4-year spot rate, 1 plus R4 to the power 4 into the 4 to 5 forward rate, 1.12. So from here I can find out my R4, right? So what I will do for finding out R4 is 1.1182 to the power 5, right? 1 plus this to the power 5. I divide that with 1.12. So divide this by 1.12. This will give me 1 plus R4 to the power 4. So raise this to the power 1 by 4 to get 1 plus R4, and then subtract 1 from it to get R4. So my R4, which is the 4-year spot rate, the 4-year spot rate is going to be 11.7%. So the 5-year spot rate, which is 11.82%, the 4-year spot rate is 11.77%. Now I can very well compute a 3-year forward from time 1. So all I require is f between 1 and 4. All I can take is 1 plus r4 to the power 4 is equal to 1 plus r1 into 1 plus f between 1 and 4 to whole cube. This is for a 3-year period. So from here I can find out f between 1 and 4, 1 plus r4 to the power 4. Okay, this is r4, 1 plus r4 to the power 4. See, this is how we have to make the simplification. This divided by 1 plus r1. R1 is only 8.8%. So this number I divided by 1.088. So this makes it 1 plus f14 forward between 1 and 4 years whole cube. So what I will raise this is this I will raise for a 3-year period. So to the power 1 by 3. So this will give me 1 plus the forward between 1 and 4. Subtract 1 from this. This gives me the 3-year forward interest rate. 3-year forward interest rate between 1 and 4 years. That makes it 12.78%. And now there is a question that is being asked. 882 that comes at each of the 3rd, 4th and 5th years. 882, 882 and again another 882. This is in the 3rd year, 4th year, 5th year. Now if I want their present values, all I'll do is I discount the cash flows with their spot rates. 1 plus the 3-year spot rate is 11%. Whole cube. Okay, so this divided by 1 plus the 4-year spot rate is 11.7% to the power 4. And the last one 882 divided by 1 plus the 5-year spot rate to the power 5. So the overall summation is coming out to somewhere around 1714 rupees, 1714 rupees 60 paisa is what is the present value of all these 882 received over a 3-year period. So I mean the main intention of dealing with this numerical is the flexibility or the ability to convert between the spot rates and the forward rates, the ability to play around finding the forward rates given the spot rates, finding the spot rates given the forward rates, and finally using the various rates to determine the present value of any investment. That is what is the most important thing that needs to be comfortable with as far as the spot and the forward rates are concerned. All right, let's take up one more example relating to finding out the spot rates from forward rates from spot rates kind of scenario. The 3-year spot rate and 7-year spot rate, right? The 3 years, which is Y3, is 6.5%. And Y7, the 7-year spot rate is around 5.5%, right? A 3-year forward rate from time 4, F4 comma 3, the 3-year rate from time 4 is 5.7%. So what does that mean? So we know the rates between 0 to 3, that is the spot rate. 3-year spot rate. We know the rate between 0 to 7, that is the 7-year spot rate. We know the rate from 4 to 7 because 3-year rate from 4 is 5.7. All we don't know is the rate between 3 and 4. But by equating these two things, we should be able to get the rate between 3 and 4. How do I get that? We, as per our equality of the relationship between these two, 1 plus y7 to the power 7 should be equal to 1 plus y3 cube multiplied by 1 plus f31 means 1 year forward rate 3 years from now. So I have come here and this I will take as f43 to the power 3. So this value is known, this value is known, only this is unknown. So from here I can compute my 1 plus f31 as 1 plus y7 to the power 7 and divide the same by 1 plus y3 cube multiplied by 1 plus f43 cube. Right, so let's try that out. Y7 is 5.5%. So 1 plus f43 is nothing but 1 plus y7 5.5% to the power 7 divided by 1 plus y3. Y3 is 6.5% cube multiplied by 1 plus f43. 1 plus f43 is also 5.7% cube. So this is 1 plus f43. So from here I can find out my f43 as this number minus 1. So the forward rate, 3-year forward rate between 3 and 4 years is somewhere around 1.97%. And if I want to know the 4-year spot rate now, the 4-year spot rate again can come out as 1 plus y4 to the power 4 is equal to 1 plus y3 cube into 1 plus f31. So we have 1 plus y3 cube, we have 1 plus f31, so 1 plus y4 we can easily compute. So 1 plus y4 if I want, I can directly find out 1 plus y3 cube. Y3 is 6.5%, 1 plus 6.5% cube multiplied by 1 plus f31. Right now we have got the, oh sorry, this is 1 plus f31 itself, right? So I'll take this as 1 plus f31, 1 plus y3 cube, 1 plus f31. This entire thing I have to raise it to the power 1 by 4. To the power 1 by 4 will give me 1 plus y4, and from here I can compute my y4. So the 4-year spot rate in this case came out to 5.35%. Right, the 4-year interest rate. So this is F31, 1-year rate after 3 years. So this again works out to F31 is this much. So the 4-year spot rate through this mechanism is 5.35%. Using these numbers, I can again find out the value of the bond or any other instrument which involves the interest rates through the similar process itself. So that getting a comfort level in terms of these computations is very important to get a hold on this subject. Now we can see how do we compute the bond price given the spot price. We have seen the mechanisms of how to compute the spot price from the bond, right? The spot price from the bond price, typically through a mechanism of bootstrapping. Now, once I am aware of the spot prices for various years, how do I use that information to compute the price of any other bond? The price of any other bond, and decide on whether it is overpriced or underpriced kind of decision. So that is one powerful application of the spot prices and valuing the bond using those spot prices. So just getting into it, we have a 1 year spot rate, a 2 year spot rate, 3 year spot rate, and 4 years. We have also understood that the clear definition of the spot rate is nothing but that particular rate when I am investing something today and I am receiving everything at the end of that particular. When I say 2 year spot rate is 7.5, when I invest something today and I get everything at the end of 2 years, which is like a zero coupon bond, what is the effective rate of return, effective annual rate of return during this 2 year period? That is what we are calling as the spot rate, and especially with respect to the government securities which are not exposed to any kind of risk. So we have a 1 year spot rate, 2 year spot rate. So a 1 year spot rate is 7%, a 2 year spot rate is 7.5%, a 3 year is 8, and a 4 year is 8.5%. Okay, so this is years, and this is spot rate. Then compute the price of a bond which pays annual coupons of 7.7%. So the coupons that are paid for the bond at the end of the first year, some 7.7 is being paid. Like that, at the end of each of the years, per 4 years, there is a 7.7 that is being paid as coupon. But at the same time, it is said that redeemed at 123% after 4 years. Mean at the end of the 4 years, the maturity, what is being sold at maturity, even the redemption price is 123. 123% of 100. So along with this coupon in the final year, even a principal redemption value of 123 is also being paid. So the total cash flows, instead of calling them coupon, if I am calling it as coupon, let me keep it as 7.7 itself. But at the same time, there is a principal repayment or redemption value, right? It also has a redemption value, where in the 4th year we are getting 123. So probably I'll call it as total cash flows in each of the years. So in the first year only 7.7, because there is nothing that is redeemed. The same is the case first 3 years, but the 4th year the cash flows are 130.7. Now all we are being asked for is, using the spot rates, find the value of this bond. So discount each of the cash flows by their corresponding spot rate. So discount each of the cash flows by their corresponding spot rate to get the corresponding present value. So this cash flow I will discount it by this spot rate. Fair enough. Then this cash flow, I will discount it with this spot rate to the power 2 because this is a 2-year spot rate. Similarly, this cash flow, I will divide it by 1 plus 3-year spot rate to the power 3. And similarly, the last one also, this cash flow, I will divide it by 1 plus this particular spot rate to the power 4. So these are the cash flows, right, to the power 3. These are the cash flows which will give me that the total present value in this case is the simple summation of all these things, giving me 114.28 is the value of this bond. 100.28 rupees per every 100 nominal value of the bond. The current price of the bond should be 114.28 rupees, or it should be sold at 14.28% premium over the par value. That is the way we compute the price or the worth of the bond from the spot prices. And also there is a mention about a 4-year par yield. When I say 4-year par yield, it is nothing but assume that assume that you are receiving the same cash flows, and even you are receiving the par value on maturity. You are not receiving the coupons of 7.7. So what is that particular element where the coupon value is same as the yield? That is what we are talking about, right? The coupon value being same as the yield. So probably it's like saying, if I take some C here, each of the periods, and on the maturity I will take 100 plus C. This C is each of these years. When I discount them with these spot rates, right, it should be equivalent to this particular price. That is what we call as the par yield. Instead of having a coupon of 7.7, I want to decide on this particular coupon. I want to decide on this coupon and a redemption value of par value only. The redemption value should be a par value itself. If I consider these two things, or probably here I can still continue for a redemption of 115 times itself, or one redemption of 123% itself. See, when we talk about a par yield, I am looking at redeeming it at the par value, and what is the coupon that comes out in this process, all C's and 100 plus C. So the expression is probably like C by 1 plus R, C by 1 plus R, 1 plus R2 squared, plus C by 1 plus R3 cube, plus C by 100 plus C by 1 plus R4 to the power 4. This should be equivalent to 114.28. This is what will give me my par yield for the same. This would give me the par yield for the same. Even this should be equivalent to 100 itself. because we are not selling it at a premium, we are selling it at a par value itself. So all these things each year discounted at different rates, it should work out to the same 100 itself. So that is what we are calling as the par yield. So for that, how do I find out? I simplify this divided by 1 plus r, this divided by 1 plus r squared. So if I take out the c, if you just see this, if I take out this c, it is nothing but 1 by 1 plus r, 1 by 1 plus r squared. So each year it's a spot rate itself, 1 by 1 plus r3 cube, 1 by 1 plus r4 to the power 4 plus 100 by 1 plus r4 to the power 4 equal to 100. All the numbers are available for us. So what we can do is first compute the discounting factors. Discount factors 1 by 1 plus r, like that. 1 by 1 plus r to the power this. Directly when I do this, okay, this is the discount factor. So for 4 years, these are the discounting factors. So the summation of those 4 is what is the multiplier for C. So probably let me take the summation of those 4, which would be the multiplier for C. So 3.315 C. So this entire thing now becomes 3.315 C plus 100 by 1 plus R4 to the power 4. So 100 multiplied by this is 100 by 1 plus R4 to the power 4. That should be equal to 100. So if I take the 100 to the other side, it becomes 100 minus of this. So 3.31C is equal to 27.84. So obviously from here I can get my C value, which is nothing but 27.84 divided by 3.31, saying 8.39. I'm making this in a general format with just 2 decimals. So it is working out to 8.4. So the par yield in this case, see, the par yield is nothing but if I am taking a constant coupon, the maturity, the redemption value is the same 100 and the purchase price is also 100. When I set the price as 100, redemption value as 100 and equal coupons across, and find out what is that particular coupon which will create this kind of a scenario, that particular yield is what we call as the par yield, right? So the par yield in this case we can very well obtain as 8.4%. Alright. Now let's look at how do we compute the price of the security, a price of a bond given the forward rates. Let's say 1 year forward rate, 1 year from now, 2 years from now, 3 years from now, given the forward interest rates, how do I compute the price of the security? So we know the relationship that for a 2-year security, investing it for 1 year and then reinvesting for 1 more year, the return should be the same as investing it for 2 years at a stretch. Otherwise, it creates arbitrage opportunities. So from that standpoint, a 1 year investment and a 1 year forward rate from there should be matching the 2 year spot rate. So the other way of talking about is if the 2-year rate is R2, 1 plus R2 square should go as 1 plus R1 which is a 0-year investment, and then reinvesting the same at some other rate F, which is the interest rate between 1 and 2 years. So these two should be the same, and this is what we call as the forward rate. So in this case, what it is saying, let FT denote the 1-year forward rate over the year T to T plus 1. So this is T. So probably it is like this is the forward rate between 0 to 1. Then it is nothing but the spot rate itself. Whereas this is between 1 to 2 years. This is the rate between 2 to 3 years, and this is the rate between 3 to 4 years. Now, our instrument, a fixed interest security, pays a coupon annually in arrears at the rate of 6% per annum, which means at the end of 1 year it is going to pay a 6, at the end of 2 years it is going to pay one more 6, and at the end of 3 years it will pay a coupon of 6, and the face value, the nominal value also would be refunded, which is 100. So cash flows wise for this security, after 1 year there is a cash flow of 6, after 2 years there is another 6, and after 3 years there is 106. But the point is, because the interest rates are different for each of the periods, the discounting factor will differ for each of the periods. So one way is, now that we had forward rates, we can find out the spot rates for each of the periods. Right? Okay. So we can take 0 to 1, 1 to 2, 1 to 2, 2 to 3, and 3 to 4. The forward rates. Forward rate is 4.6%. 3.2% means the interest rates are going to fall between 1 to 2 years. Then 3.2 to 3 years, it is again slightly rising to 4.1. But between 3 to 5, there is an expectation of 6.5. But this is immaterial to us because our security is having a maturity of only 3 years. This is just not relevant for our for this particular caselet. So what we should typically try doing here is, I can find the spot rate because the pricing of a bond, the cash flows, either I discount them based on the yield to maturity, which is one single interest rate for all the periods, or I discount them based on the spot rate. Spot rate is nothing but like this. R1 is the 1-year rate. R1 is the 1-year rate. R2 is the 2 years rate, which is computed based on the 1-year spot rate and the forward rate between 1 and 2 years. And 1-year spot rate is same as 1-year forward rate because both of them represent the interest between 0 to 1 years. So when I am talking about the spot rate for the first 0 to 1 year, this is going to be the same. But when I want it as between 1 to 2 years, or probably for 0 to 2, the spot rates always go as 0 to 1, 0 to 2, or probably it's a 1-year spot rate. The 2-year spot rate means it includes 0 to 1 as well as 1 to 2. The 3-year spot rate includes 0 to 1, 1 to 2, 2 to 3. So here it comes out as 1 plus the 1-year forward multiplied by 1 plus the 2-year forward. This entire multiplication I divide it by zero point 0.5. I raise to the power of zero point 0.5 because 1 plus R2 squared, 1 plus 2 year spot rate squared is equal to 1 plus 1 year spot rate into 1 plus the forward rate between 1 to 2 years. Same way I will work for 3. 1 plus R3 squared is equal to 1 plus R1 into 1 plus the forward rate between 1 and 2 into 1 plus the forward rate between 2 and 3 years. So this is 1 plus R3 cube because this is for a 3-year period. So the R3, which is the spot rate, 3-year spot rate, will come from that process. So here I multiply those 3 and I take it to the power of 1 by 3. The same way when I am working for 2 years, I take it to the power of 1 by 2, which is 0.5. So this minus 1 will give me my 2-year spot rate. So in this case, the 2-year spot rate has become 3.9%. And when it comes to the 3-year spot rate, I'm doing it as 1 plus 4.6 multiplied by 1 plus 3.2 multiplied by 1 plus 4.1. So all these three again I have to take that to the power 1 by 3 to find out the forward rate. So I am raising it to the power 1 by 3 and then subtracting by 1. So this is taking my 3-year spot rate to 3.97. Obviously, I don't need the 4-year spot rate in this example because my security is only for 3 years. But in case I want to talk about my 4-year spot rate also, it's nothing but I'm doing a multiplication of this, and then 1 plus 4.1, and then I'm also multiplying with 1.1 plus 6.5. This entire thing I raise to the power of 1 by 4 this time minus 1. So making it almost 4.6%, 4.59% as the 4-year spot rate. Okay, so from the forward rates, I can compute the spot rates. That's one thing. But my intention is not the spot rate. I have to find out the price of the security. So what I'll do, the cash flows that are coming from this security, because it's an annual coupon based security, the cash flows in the first year are 6, second year are 6, and third year the cash flows are 106 because even the principal also will be refunded. The nominal value or the face value also will be refunded at the end of the redemption period. So what I can do is each of these cash flows I will discount it by their spot rate. So the present values, if I want to find out, this 6 I will discount it by 1 plus the spot rate for 1 year. Then this particular cash flow I will discount it by 1 plus the 2-year spot rate squared. Then this cash flow I will discount it by 1 plus the 3-year spot rate cube. So these are the present values of all these scenarios. So the total present value is the price of the bond. The price of the bond is nothing but the summation of these three elements. So the price of the bond in this case comes to 105.62. So this bond is being sold at a premium because the face value is 100 and the price associated with this bond is 105.62. That is how, if at all the forward rates are present, I will get into converting those forward rates into the spot rates and then use that spot rates for discounting the coupons and the principal repayment at the end of each period. and then sum them up to find out the total present value, which is the price associated with that particular bond. And now if I want to know what is the gross redemption yield that is associated with that particular payment, right? Now that I know that the cash flows wise, I have to pay my cash flows now are initially, right now there is an outflow of 105. At the end of 1 year, I'm going to get 6. At the end of 2 years, I'm going to get 6. And at the end of 3 years, I'm going to get 106. So based on this, I can find out the IRR. That is what is the gross redemption yield. Now forget about the various rates, which are the spot rates, forward rates, where each cash flow is discounted by a different percentage. I'm not bothered about all those things now. I'm only looking at, if at all I have to pay 105 today to achieve these kind of cash flows, what is the overall return during this process? That IRR which we are computing without any without considering different rates for a different period is what we call as the gross redemption yield. Based on the overall redemption and the purchase prices, what is the overall yield that is coming up in this investment, which is nothing but a simple IRR computation process, wherein I try to find out the IRR of this, where the total present value of the inflows equals the present value of the outflows. That is what we call as the IRR, and in this case this is working out to somewhere around 3.97%. 3.97% happens to be the overall IRR for this period, which means the gross redemption yield, especially in this case of bond, where I'm looking at different forward rates for different periods, resulting in different spot rates for a different period. If I want to find out the overall yield for my investment, I can directly find out the IRR of the investment, which tells me that for this case 3.97% happens to be the IRR, or the gross redemption yield. So you should be comfortable with respect to computing the pricing as well as the gross redemption yield in case the information about the spot rates or the forward rates are available to you. All right. Now let's look at the concept of immunization, as we have already discussed. When we say a particular portfolio is immunized, when we say that the position of our investments is immunized, or the position of a fund is immunized, we know that there are three major rules that need to be satisfied to make sure that fund is immunized. There are three rules that need to be satisfied. One, it talks about the present value of the assets should be equal to the present value of liabilities. Just a quick recap of the immunization rules. Then we also know that the duration of the assets should be equal to the duration of liabilities. Only then we say that our fund is fully immunized against small changes in the interest rate. Even if the interest rate change slightly, we are not that badly impacted because of our fund. And finally, the third rule being the convexity of our assets is greater than the convexity of the liabilities. these are the three rules that are associated with the immunization of the fund. So, probably if this is the fund we are talking of, how do I look at how many of the rules are being met for it? Right? Are all the three rules met? Or is it only the first rule that is met? Or is it only the second rule that is, or is it only the first and the second rules that are met? That is what we really need to look at when we have to assess that our fund is fully immunized. So, looking at that particular aspect for this numerical, there is a pension fund which has a liability of 71.8 crores of rupees to be met at the end of each of the 9 years. So at the end of each of the 9, so at the end of 1 year from now, let's say if I am putting a timeline 0, 1, 2, 3 up to 9, at the end of each of the 9 years, there is a 71.8 crores of liability that is there up to this much period. Now, these are the liabilities for the next 9 years for this particular firm, for this particular fund. Now, what we are looking at is assets wise, they have an option to invest in two zero coupon bonds, one maturing in 4 years and the other one is maturing in 15 years. Assuming the interest rate is 5% effective, how do I find out how much proportion needs to be invested in this bond versus this bond? What should be the face value of this bond versus this bond to make sure that at least the first of the rules, the present values, the second of the rules, the duration of the assets is same as that of the liabilities. For that, first of all, I need to find out the present value of the liabilities as well as the duration of the liabilities so that I can decide how much to be invested in the assets so that the present value of the assets become equal to the present value of the liabilities, the duration of the assets become equal to the duration of the liabilities. So how do I find out the present value of the assets here? Straightforward. Present value of the liabilities, 71.8 crores to be met at the end of each of the 9 years. So the present value is nothing but 71, it's a regular annuity. So 71.8 and A9 multiplied by A9 and that too at the rate of 5% interest. So that's what either I can compute the same or either I can get the value for the A9 corresponding to the 5% interest rates from my actuarial tables. So if I am doing the same, the A9 corresponding to 5% interest rate from the actuarial tables is 7.1078, right? So what I could very well say is 7.1078 so the present value of the liabilities in this case, okay, PV of liabilities in this case is going to be 71.8 multiplied by 7.1078. So the present value of the liabilities overall is 510.34 crores. That is the present value of the liabilities. So I have to make sure that the present value of the assets also will be matching up with that particular number to make sure that my portfolio is immunized towards small changes in the interest rate. Then the same way I can look at the duration of liabilities as a straightforward formula we can remember. The duration of the liabilities is nothing but the 9 times, because it's a zero coupon bond, 9A9. right? The duration of the liability will directly become 9A9, or probably I can take it as, sorry, 9IA9. The duration of the liabilities is working out to 9IA9, because I am looking at not a single time payment. It's a recurring payment. So we are looking at this duration as 9 times IA9. So I could very well get that duration value 9 IA9 divided by 9 times A9, right? Or I could have taken it as IA9 by A9. The duration will work out for me as IA9 by A9, and corresponding to that 5% itself, I could take my IA9 as 33.2347. So IA9 is 33.2347 divided by A9, which is 7.1078. So based on that, it is coming out that the duration of these liabilities is around 4.675 years, right? Because it's a annuity. The duration, see, typically when I am talking about the duration, it is nothing but the time weightage that we are giving. So probably if I am talking about one that is coming at the end of each period, my present values have been v squared, v cube, so on, whereas my durations have been 1v plus 2v squared plus 3v cube, which is nothing but it's an expansion of IA9. So that's where we say duration is nothing but IA9 by A9, which is giving me that it is 4.675. Now I have to make sure that the assets which I am investing also, I have a 4-year asset, 4-year maturity zero coupon bond, and a 15-year maturity zero coupon bond. So let's say I am investing some X in it and I am investing some Y in it, or probably when I look at the maturities of each of these zero coupon bonds, whatever are being invested, so I could very well look at the face value of this particular bond, which will give me X on after 4 years. Right now the present value of that is X into V power 4. Similarly for this, if I am investing Y in it, Y into V power 15. That is what is the present value of the assets. Now as per the immunization rule, the present value of the asset should be equal to present value of the liabilities, which is 510.34. So this is the first condition that needs to be met. Then the second condition that we are talking about is the duration of the assets should be the same as the duration of the liabilities. So what is the duration of the asset here? The duration of the asset, if I say 4x v power 4 plus 15y v power 15, this is what is the duration of the liabilities. Sorry, this is the duration of the assets. The duration of the asset should be equal to the duration of the liabilities. So the duration of, these are the duration of the assets. Of course, this 4x v power 4 plus 15y v power 15 divided by v power 4 plus v power 15, x v power 4 plus y v power 15 is what is the duration, and that should be equal to 4.675. Now the duration of the asset liabilities is equal to the duration of the asset. This is the duration of the liabilities, and this is what will come out to be the duration of the asset. The change in price by the price. So XV per 4 plus YV per 15. We know that this particular value is the XV per 4 plus YV per 15. We know that it is 510.34. So regarding the duration, I get 4xv per 4 plus 15yv power 15 is equal to 4.675 into 510.34. So the other side, the other equation that comes out is something is 2386.25. So that means I have two equations now. X v power 4 plus y v power 15 is equal to 510.34. The other equation we have is 4x v power 4 plus 15y v power 15 is equal to 2386.25. These are the two equations. Now probably I can do a simplification saying I can find out per x and y. So multiply this first one with 4. It gives me 4x v power 4, 4y v power 4, 15 is equal to 510.34 into 4. So 510.34 into 4 gives me 2041. And now when you are doing a simple arithmetic subtracting the first equation from the second, it gives 11y v power 15 is equal to whatever is the difference. So 11y v power 15 is the difference between these two things, 344.89, that is 11y v power 15. So from here I can get my y as 344.89 divided by 11v power 15. So what is the 11v power 15? In this case, the v which we are taking is 5%, right? So v, because I is 5%, so v will be 1 by 1 plus I. So this is the value of v, and from here v power 15, if I want this to the power 15. So this is v power 15. So 11 into v power 15 gives me 11 multiplied by this. So the value of y which can be obtained from here, 344.89 divided by 11v power 15. So the y is saying you invest 65.18. So the amount that needs to be invested in the 15 years fund, we go with a nominal value, face value of 65.18 in a 15-year zero coupon bond. The same thing, you substitute that number back into your first equation, probably 4x v power 4 or probably xv power 4 plus y, which is 65.18 v power 15 is equal to 510.34. So probably xv power 4, if you want, x into v to the power of 4 if you want, all that is coming out is 510.34 minus 65.18 into v per 15. 65.18 into v per 15. So this is what is coming out to xv to the power of 4, and from here I can get the value of x. From here I can get the value of x. which is this number divided by v to the power of 4. So for that it's better that I compute v power 4 also, which is this particular v to the power of 4. So I can very well say x is 478 divided by v to the power of 4, giving me that in x you invest 582.21 582.21 crores. Let it go as a part of investment in X. The face value of X, let it be 582.21 crores, and the face value of Y, let it be to the extent of 65.18 crores. So those are the kind of investments that go as a part of to make sure that uh, the investment is completely immunized. At least the first two rules of immunization are met. The investment should be 582.21 crores in a 4-year zero coupon bond and 65.18 crores of face value to be invested in a 15-year zero coupon bond. This will make sure that the present value of the assets is equal to the present value of the liabilities, as well as the duration of the assets will be equal to the duration of the liabilities. Alright.